broadly, if you've got anything that you want to contribute, we've got just if you throw it up in the app, we're going to throw it into this digest, sort of our way of keeping track of who's doing what, all the events. And we're going to emphasize in the September 16, 17 event. Again, we've got one of my favorite things I know that we're doing something right is when I have CIOs from endowments wanting to be with the families, and we're doing that at 9 a.m. And we're going to really emphasize the alumni on the second day, so it doesn't get lost at the end. And you're going to see a lot more activity there. So we keep on adding schools. We're going to have Erica Orange from the Future Hunters do a discussion with some other panelists on the future of education and training on that second day. So we're going to, but I think it's.
Oh, hey Tracy, this is Phil Eichler.
Yeah,
I filled out a service request over the weekend, and I haven't heard back from you all, so I wanted to follow up.
Billy, are you talking to us or are you talking to your?
Yeah. So I
have to mute him there. I think he's talking to someone else.
Yeah.
Mark, is there a VC or panel around fund allocations for the September 16th conference?
There is and again, you'd see, it's a breakout by these groups here.
I see.
And we are one other emphasis we've been putting on is fund of funds. We're gonna have a lot of people from the allocating side at the 9 to 11, and then we I don't know if Richard DeVilliers is on, but we've got a couple speakers that might be proposed. The CIO of UBS, as well as ARS. So different macro views and sort of a diverse panel, and then we break out by interest, including adventure. And yes, you want to meet allocators, but part of it is sort of you don't have a long discussion, but you want to. Well, we're going to try to, if you want to have something to present, that's where when you come to this shared sheet by group, and you can see it on the website, if you click on VC, this takes you to the breakout decks where you can throw up your slides.
Okay, great, excellent. I think I have some stuff to contribute to this section.
And basically, the cadence is, I think it's 11 o'clock, is that we're going to do every Thursday, so the sort of Tuesdays and Thursdays, 10:30, where we get together and have a chance to, coordinate on events that we want to see. And then we definitely could do a venture, broader venture event than FinTech. So it's 11 o'clock. What I wanted to do, yep, someone have a question? So what I wanted to do is, if I go back to the agenda, is, and a lot of people are on vacation, including Joe this week, is go through, I guess I basically did a poll, so I want to just, a lot of the people on this call have already heard it, but I'll do a quick one. Just about the events that are coming up. We have this group of events that were proposed from the group on Thursday. Just earlier today, we're adding SPACs. Basically, all these SPACs that have launched, some of whom we're close to, some of whom we're not. They want deals, and so we've got a lot of people that will have deals. So we'll sort of parade them in. I know that Silver Spike, I don't know, is anyone from Silver Spike on? I don't see them. Bill Healy and his team, they've done one and they plan others. So we're going to do one on SPACs. I'm going to do a quick poll if you've done this, some people, maybe we'll do this. I see more people coming in. So we'll that's the sort of event side of things. The other bit, just to, if you've just joined, is we're having this cadence, we're having this digest, and Tuesdays and Thursdays we get together. Next week will be a little off because of the holiday, but it's great seeing not only events happen, we are seeing deals happen, sort of organically in the network, which is great. And if you have a deal, we can try to be helpful officially on onboarding it. We can talk about that separately. And then finally, I wanted to, before I turn it over to Sean Lawless, who's got some really great data to share, on the macro updates, is I thought I didn't get a great response in terms of what I want to do going forward. Is that if you want to share, actually, with a couple exceptions, and we'll fit you in, is let the icebreaker breakouts happen a little longer, and allow you to. Someone said last time, let's maybe we have a question to answer. So my question is really get a consensus when I hit the breakouts. Is talk about me, introduce yourselves. But ask each other what scares you the most and excites you the most in terms of the investment landscape. So I'm going to set up these rooms, and we're going to make it 5 minutes, maybe a little longer, maybe 7 or 8. And again, just what scares you the most and excites you the most, and then someone can come back and just report back to the group, and then we'll turn it over to Sean and go through his presentation. Any questions? Here we go. Hi, Jim.
Hey, Mark, I missed your call last night. Can we talk this
Yeah.
afternoon?
Yeah, we can talk later. I think Autumn is not on. Jacob Levo, are you on? Or she's on.
I am on. I'm just not sure what I can contribute on behalf of Lisa in this topic.
Well, we want to know if you're her proxy from the vantage point of NYU. What excites you, and like how's NYU doing with COVID?
Oh, well, I mean, NYU is incredibly agile, so I think that from my perspective and being someone new to the team, that has been really exciting to see how co-creation can happen under the leadership of someone as strong as Dr. Coleman. So that's, for me, been incredibly exciting, right?
But what scares you?
I don't know that I've had fear as much as I have realizing that the pace that we are in is normalizing in the sense that it will continue to be this intense, and I think that one of the things that a recent article that Dr. Coleman shared was thinking through that these are disruptions that will continue to occur if it's not the pandemic and its continuing implications, that we always have to be prepared for disruption. Sure. What the disruption is may change, but these disruptions
Good points.
Are part of the course. And so how do we maintain the ability to escalate and maximize as we move forward, expecting disruption?
Sorry to cut you off. We have a limited time, so letting everybody go around. Torrin, you went on video. It sounded like you're ready to say something.
Oh, sure. What scares me the most, I just heard that New York has officially pushed back their return to school date for in-person learning from the 10th to the 21st, and I think it's a sign of more things to come. I don't know how people are going to continue to work from home if we can't help them take care of their kids. At some point, I think the mental health and well-being of the parents is going to become a serious issue.
Yeah, a lot of counterbalancing things here. Jim, what do you think?
I think the uncertainty, the risk of the uncertainty is paralyzation. And I think paralyzing people because of fear is really is my biggest concern on this, because at some point, we need to understand, adopt, recognize the risks, and be willing to move on. And so, we're not the first people. We're not the first. It's not the first time that the world's going through an incredible uncertainty. I don't know of other times when the world has gone through such uncertainty that the result has been stop everything.
Mm-hmm.
And I think that culturally, I think we are reacting in a way that our grandparents was marveled at it, and so my fear is that our reaction, and I'm not sure what's appropriate, what isn't appropriate, but the level that we're paralyzing ourselves has immediate and unbelievable consequences financially on not only this government and the United States, but global governments. And that really economically really worries me.
Jacob Lebo, you're on. Thanks, Jim.
Yeah.
You're from the.
Hey, guys.
Usually you're in Abu Dhabi, but now you're in the middle of the Midwest.
Yeah. So that's actually one thing that's exciting to me is I'm around my folks and home and family, and to be able to do that during a pandemic, we're feeling very lucky. Some of the things that scare me, obviously some industry-specific stuff. Have some interest in travel technology, and obviously with limited travel, no business travel, the prospects of that company is looking very, very dire right now. Something that I'm involved in, based out of Europe and the Middle East. So that's kind of a specific one. And then I guess Torn shirt, it kind of made me think of the upcoming.
I can't see the shirt, Torn. What's it say?
It says, "Democracy dies in the darkness." It's the Washington Post's motto.
Okay.
So upcoming election has obviously got me and I'm sure millions of other people fearful. So let's see how that goes.
Okay.
So yeah, but again, grateful to be around family right now. That's been very important for me as I've moved 8,000 miles temporarily. So
We should catch up too.
Yeah, of course.
So who else wants to speak? Vadim Balashov, you're on from Austria. I hear Europe is now having a slight resurgence across France, Spain, Germany. How about Austria?
Europe is on the Austria is taking a lead from Germany, obviously. Europe is on the way to somebody. I think I read it this morning. The disease is with us. It's completely uncertain. We got to start doing something. We got to start living.
Mm-hmm.
That's the mood here. What scares me most is the glut of tech IPOs, right? The perceived IPO.
Why does that scare you?
Tech valuation level.
Okay.
Well, if most of the IPOs don't perform, if some of them or most of them end in a disaster like WeWork, or ended in drops in values soon after the IPO, then that will close the IPO window for years to come, and the entire will have a ripple effect throughout the entire.
Let me ask another person who we were probably in a room with 15, 20 years ago, Dmitry Alimov. We're just going around saying what scares and excites us. Dima, you on?
Yeah, I am on. I wasn't really intensive to speak, but thanks for the cold call.
We're interactive.
Well, look, I mean, we're just as excited about the technology sector as we were years ago. It continues to deliver on many levels and basically taking over more and more of the economy. So that's a lot to be excited about. In terms of what scares me, how wide should I go on this one? I mean, obviously, massive market correction direction would be unpleasant. It would distract from a lot of productive activity, at least in our sector. So I wouldn't wish for that, although sometimes it's a time of opportunity as well, but at the cost.
Mm-hmm.
And of course, political instability in the U.S. Would be a scary one as well.
Fair enough. Who else wants to speak, and who wants to speak for the group? Donald.
I can speak, but not for the group because I came in late.
Okay, I guess you and Jerry. Maybe I'm going to leave and go back, and then maybe like 2 minutes we'll wrap this up, and somebody can speak. I'll let you guys decide. Torrin does a good job usually. And he can show his T-shirt.
I've got
and it's obviously surpassing pre-COVID levels. And I'm concerned that we could see a meaningful decline when the September numbers come out in 2 weeks, which could then lead to somewhat of a downward spiral in markets. Thanks, Jonathan. Yvonne.
MJ must be the moderator. Richard, we have to talk. Keep going. 1 minute though, guys. Hi, Peter.
All right. Hey guys, I'm sorry, my
financial downturn when a lot of financial services are faced. I think on a practical basis, you're going to see a lot of companies that are going to look at this as a huge cost savings long term. So I agree that I think a lot of companies will give back office space or they will repurpose their office space.
So, guys, 30 seconds. We're going to all get back together. Just letting you know.
Software companies, portfolio constructed, active management, etc. So if you'd like to speak about that, feel free to reach out.
You guys ready to go? We're gonna come back.
Yes.
All right, cool.
Yeah, Nisha, reach out to.
20 PE, and now it's I think like mid 50s or 60 PEs. No news, in 6 months. Just I guess a lot more people are buying spandex.
Hey, Darren.
Yoga pants. So, anyways, I'll stop talking.
We're gonna call everyone back together. Who's gonna speak for you guys?
Sure.
Twist your arm. Okay. All right, we're back. So I was just on with Phil Kessler's group. So Phil, what scares and excites from your side of at least your breakout room?
Yeah, we spent most of the time kind of talking about the hot topics in public equities. So current market valuations versus, the impact of the election in November. And kind of the bottom line was no one's really enthralled with either choice. And so you're trying to read the tea leaves of the impact of one or the other of them getting elected. And I'd say general pessimism on the mood. Not outright fear, but certainly no one's excited about the future at this point.
Okay. MJ, I saw you moderating. Are you excited about the future?
So, it seems that the general consensus is we're excited, but there's a moving target. And it's very, very hard to adapt to the moving target because we never know what's going to happen from one moment to the next. It was pointed out there's a lot of fire sales going on and people selling at lower valuations that people are taking advantage of. Towards the tail end of the conversation, we spoke about the fact that, we should really start putting our investment dollars into the social impact causes that COVID has kind of put on steroids, whether it be racial inequality, social injustice, prison reentry, people overlooking things like addiction, equal opportunity for employment, and all of these things which are so necessary that we really kind of, again, COVID exposed, and we really need to start thinking and investing with purpose and profit equally, not just with our wallets and pocketbooks.
Fair enough. Thank you. Sean Lawless, were you the speaker for your group or someone else? And you're muted.
I don't know if I was the speaker, but I'll give you a quick rundown. I think, the fear is around valuations, which I think we heard from other groups. The thought that, you've got some money coming in with some inexperienced people that are going to end up getting hurt in the end. The fear as we're remote, the idea of the increased cyber attacks that are happening are a fear. And I'd say on the excitement side, in periods of change, it just creates opportunities, and new opportunities are being created, and that's what's got people excited.
Great. Brett Hickey, I don't know. I don't think I visited your group. Who's speaking for your side?
He was a member of our group.
Oh, he was? Okay, sorry. Then Torrin, who's all right.
Sure.
I'll take it. You have to show your T-shirt though.
All right. Apparently there were some comments about it. It says democracy dies in the darkness. It was the tagline for the Washington Post a couple years back, and probably is just as relevant today as it was a couple years ago. Our group had an interesting discussion about the long-term effects of current thinking along mixed monetary theory, MMT, and whether that may result in the fall from grace for the US dollar, and maybe more of a focus on the Chinese currency as the currency of choice around the world. I think there was confidence across the group in the ability of a lot of people's organizations to be agile and to move into opportunities that are going to succeed in this landscape. I think a lot of us work for more agile organizations than some of the more entrenched banks. So I think there was some hope, but some concern as well.
Mm-hmm. And who else? I guess Turner or Bill, your breakout.
Yeah, we talked a little bit about kind of the private equity deal making environment, given the COVID situation and whatnot, and concluding that that things are, starting to return somewhat to normal, but also related to our own experience with the project out in Nebraska, where we had to do virtually 3 months of diligence by drones and Zoom meetings, and it wasn't until we got under definitive LOI that we made the 12-hour drive to do the on-site. But so there are obviously continuing challenges to really do the type of due diligence you want to do in these things. And then we spent Azel Rosenwald, if I pronounced his name correctly, gave us a brief rundown of some very interesting stuff, very high growth situations coming out of Israel, and including an interesting wireless telecom play that we looked at last year, and in the combined physical and cyber security company that sounds very interesting. So a little bit more kind of deal chatter.
That's great. Thanks, Tony. Is that, or David Kroom, Brinkley, Caitlin, who speaks for you guys?
I think it was Tino.
Okay. Tina? Or David, Nisha, someone's, or here he is. Okay. Tino, go.
Yeah, sorry about that. Yeah, there was a concern about valuations and the state of flux in current assets, and the way the current assets are trading. Either, for example, used cars was brought up as an example, and the seemingly lack of inventory and how that's going to turn out in terms of pricing and also inventory. And then the opportunities, there seem to be I was a little bit overly focused on what's facing my company, but there seems to be a lot of hope on balance in the future, tempered with uncertainty, of course.
That's great. Did everybody get to speak? Because otherwise I'm going to, we sort of going from the micro to the macro, Sean. Should I, I'll pull up your slides.
Yeah.
Or do you want to present? Your partner in crime. So stepping in for Stephen Burke, Sean Lawless.
Yeah.
Good
morning.
Do you want to present, Sean?
It's only 3 slides, so I'd fine having you drive them.
Bastardized on my Google, but go ahead.
Yeah, I thought I would just touch on sort of this market recovery. We just went through a recession that wasn't your typical recession, right? It was an engineered shutdown of the economy. And as we're coming out of it, I would argue this hasn't been your typical recovery. While the market's rebounded, after that big drop, 34% drop, and we're now above the previous highs, it hasn't been a recovery or, the tide that's lifted all boats. A typical recovery is broad-based, and it's typically led by the economically sensitive sectors of the market. And you can see in this run up, it's hard to see on the chart, but it's really been growth stocks that have led, and your value or your cyclical economically sensitive stocks that have underperformed. And in this move, we've only have today about 40% of the stocks, positive year to date. And just to kind of give you a comparison, that's roughly half as many that were positive at this point in the 2009 recovery. So it hasn't been broad-based. The median stock is still 22% off its high. And that unevenness, I would argue is due to, the uncertainty that still remains around the pandemic. If you go to the next slide, Mark, if you dig maybe a little bit deeper into the market and look at some of the internals, we had the shutdown and then you had the reopening, and you see the steep drop in the PMIs and then that subsequent bounce in the PMIs. And while we've had sort of, again, the headline market recover, the internals are suggesting maybe something a little bit different. and you can see, maybe there's a bit of a lack of confidence in the economic recovery, looking at some of these numbers. If you look at the stock performance of financials, industrials, energy, the typically economically sensitive sectors, historically, there's this very tight relationship between the trend in PMIs and the performance of those sectors. And if you look over to the right of the page here, the breakout of that chart, you can see we've got this divergence or decoupling of the PMI data and the performance, in this case, of the financial stocks. Now, the question is, I don't think this is a permanent change, and we're going to have this decoupling. It's really going to be, this to me is sort of around the uncertainty of the pandemic and how it's going to resolve. So eventually, I think these two, again, come back together. The question is, how does it happen? Right? Do the PMIs roll over and the economy deteriorate and it brings it back down to the performance of the stocks, or does the market get a little bit more comfortable in the rebound, and you start to see a broadening out, if you will, of the recovery of the stock market, and you see some of these sectors, the value sectors, the cyclical sectors, start to perform much better. And if you go to the one last slide here, there's been a lot of discussion in the press around value and growth and that divergence between value and growth investors. And, the one thing, if you look at it, there's probably a pretty good reason why value has struggled here. And, on the chart on the left, you can see that earnings expectations, value relative growth continue to weaken. And I think, when you look at it from the market's perspective, there's just less visibility there. And again, part of this is due to the way we are reopening and how it impacts different sectors. But clearly those cyclical sectors, there's still a lot of question around, earnings as we go forward. And we've seen capital flow to the sort of the growth names, the stay at home, the work at home names, and flow away from those typical cyclical sectors. So that's kind of a quick snapshot of the market internals. And if I can, Mark, I just want to give you a few more data points around capital flows or asset flows. I got a report from Goldman Sachs just this past week, and some pretty interesting numbers. Since 2019, we've seen 2.63 trillion of inflows into cash and bonds. During that same period, stocks saw an outflow of 475 billion. So 2.6 trillion heading into bonds and cash, about $0.5 trillion heading out of stocks. And within the report, Goldman talks about they see zero upside panic, or sort of the FOMO, the notion of fear of missing out. They didn't see that flood of money coming into stocks as the numbers suggest. And they think, when you look at bonds, that's where the overcrowded trade is to them. And I saw an interesting comment as well in the report. They're saying they see the potential for FOMO, which is new to me, but that's fear of materially underperforming when they look at the mutual fund industry. Mutual funds as an industry have a September year end. So they ask the question, is this the next incremental buyer of tech in September? Because as an industry, they're underweight sort of the big five, right? So there's a potential that you get some window dressing as they're putting their books together for financials for September year end, where they're going to want to increase weights to the Apples, the Facebooks, the Amazons, Google, and Microsoft. So potentially you have some support even at these levels if you were to see some buying going in there. And just real quickly, global bonds, 20 straight weeks of inflows. Global stocks have seen redemption 7 of the last 11 weeks, despite this, record stock prices. It could be really one of the most unloved rallies on record if you're looking at the flow data. So, so some pretty interesting data, and I think, you know, from a leadership standpoint, to see that pivot or to see a broadening out of the market, it's really going to be dependent on the direction we go with a vaccine or a therapeutic or a treatment that's widely available. Because I think you're going to need to see sort of that vision of a sustained recovery in those sectors of the economy before you see that broadening out. And with that, I'll leave it, Mark.
So, any questions on what Sean threw out? No questions. Anyone disagree or agree? It's not like this crowd.
Well, I'll throw out a question just for the sake of throwing out a question. So, any consideration to the level of the amount of the impact of credit risk on these numbers? So as to say, if we see a larger wave of defaults outside of, say, retail or restaurants, which is where we're already seeing them, you know, any consideration as to, you know, what these returns would do, or what sectors are especially vulnerable, or places that people would have greater fear and likely flee?
Well, clearly the market move's been in discretionary names. So you think about the one area in the market that's worked extremely well is sort of call it the home improvement, the stay-at-home stuff, right? Like you look at a Home Depot, a Lowe's, fantastic numbers, right? And if the consumer decides one, either, you know, they're losing support in aid, or they decide they really need to start thinking about the rainy day fund and stop spending, clearly I think that's an area of the market that that would be at risk. So it's really going to be driven by, you know, in some sense it's a consumer driven economy. It certainly is. So if we do see some struggles there, you got to look at the spending and where that's going to fall off. And that would clearly, to me, be an area that would certainly be under pressure.
Sure. I was actually thinking more along the lines of corporate credit risk and what the knock-on effect would be there if we saw a larger increase in defaults on the corporate side.
And for the broader market, I think this is a market that's really going to be funneled on you know, so, to some degree from a bottom up. And I think you've seen that in the numbers. You know, when you look at, you know, where capital is flowing, it's flowing where visibility is. So if that visibility becomes a little bit, you know, cloudier in the way of credit risk, certainly that's going to impact, you know, specifically by sector. But what's interesting is the fact that you had the Fed in buying corporate bonds, and to some extent that probably de-risked the equity market some, because obviously at the bottom of the capital structure, if you're supporting the capital structure above you, that does take some of the risk out there as well, which again, I don't think people have thought about.
Hey, Sean, I'm curious with respect to the kind of technology overall and maybe the five FANG stocks, you know, specifically when we think about valuation and, you know, kind of the fundamentals are on the back burner in terms of, you know, return on investment, it seems like. So, you know, the way the valuations continue to grow, I don't know if you've looked into the fundamentals and at say market saturation. Certainly the last 5 months has supercharged market positioning, and so if you think about, you know, is the growth in earnings, the growth in revenue, how much of that's coming from, if you will, product placement versus pricing placement? You know, what's the underlying fundamentals that, you know, that's supporting it, other than people will kind of use their return on investment and look at the 10-year yield and say, gee, as long as they get better than 100 basis points, I'm good.
Yeah. Well, a couple things, Jim. We do think you've had, many of these companies have been benefactors of the environment, and it has, enhanced their business. Certainly, there's been a pull forward of some revenue, but in some sense, it's even helped their businesses. And to give you some sense, from a valuation standpoint, it's a tough call. The Magnificent Five, if we call them that, now represent 26% of the S&P's market cap. And just to give you a comparison, during the tech bubble, the comparable top five topped out at a then record of 18.5. So yeah, it's very crowded, and valuation is a concern. But you touched on something. In a zero rate interest environment, what is fair value, right? When you're discounting those earnings back or those cash flows back, interest rates do matter, and they do have impact on valuations. And it took a look at the forward PE on the S&P right now is just under 22.9, so call it 23%, and that's up quite a bit from the trough in March where we were at 13. But the last time it was this high was in 2001, and think about the 10-year in 2001 was 5.4, right? The personal consumption expenditure deflator, the measure for inflation, was running at 2.5. Compare that today, it's 70 basis points on the 10-year versus 5.5, let's call it, and 1% on the deflator versus 2.5. So the point being that it's possible you got even more to run on a valuation basis. And if you look at the sort of the Magnificent Five, currently at a 44 and change PE, during the tech bubble that peaked at 48 and change. And again, the 10-year back then was 6 and change, with an inflation almost at 3. So there is you could make the argument that valuations potentially have more room to run because of the environment we're in. For us, it's tough. It's very tough to call. But what we would say, it's not an all or nothing decision. So this is, what we've been doing is trimming positions, taking profits, and in the ones that maybe where that valuation looks really on stilts, maybe you walk away. You take your profits, book them, and walk away. We just sold out of Chegg. We were in Chegg, which I don't know if you guys are familiar with. It's an online education support tool. I got 2 kids in college. All the college kids are using it. You can order books. It's help with homework. It's tutorial. You can get a tutor. All of these things online. We owned it coming into the year. We had owned it last year on the thought that there's just so many kids in school now that addressable universe, that addressable market was pretty big. It just got to ramp up because of COVID, and now you had more online, and this became a tool that became very valuable to the student. And it's up over 90% this year, and we just decided, hey, from a valuation standpoint, who knows? But we booked the profit. So I think the way we would look at it, and what we've been talking to clients about, it's not an all or nothing decision. Take profits and trim as things get pricey, but it's a tough environment to be out of. And those that have been on the sidelines, it gets harder and harder to get back in at these levels. And you got a fair amount of support clearly from the Fed, and potentially you've got this massive amount of cash on the sidelines that could be supportive at some point too. Think about all the money in bonds, right? Just a slight backup in rates is going to eat your principal quite a bit. If you got any duration on your portfolio, a 50 basis point move is probably just eating up about 5 or 10 years of income on a pretty short move, depending on, again, your duration risk. But, you know, as people start to look at their bond portfolio and get frustrated with the fact that they're earning 70 basis points and any move up, they're losing principal. Again, you could see this allocation shift. There was an article in Barron's today, you know, talking about the fact that you've had this.
The great thing about you is you got lots of data and arguments. But I want to have keep
Sure.
going forth, which takes me to this poll. If everybody could, you know, one of the things that came out of the last Thursday, we do these Tuesday, Thursday co-leader meetings. If you want to be active in a group, just come to this Zoom on Tuesdays, Thursdays, 10:30. So one of the events, one of the formats is to have point counterpoint. You know, there are cases for inflation versus deflation. There are, you know, cases for public versus private. We want to have those people, you know, sparring, and then we all listen and join into the melee. So part of that is you know, the future of real estate. You know, those are, maybe they're talking their book, but, you know, New York real estate owners, if you look at the people who are doomsday, you know, that are going to gold and cash, interestingly, they have a large commercial real estate portfolio. And they're, you know, maybe they're keeping powder dry to lick their wounds. Or maybe they know something we don't. Gold, we talked about that in the run up. So that's going to be one of the things we talk about. That third one, just what I like to know is, as we prioritize which ones to put forward, this is separate from the global events. Although, you know, with the global events, we're going to send a survey out as well as to, in October, November, what speakers people would like to see or suggest. Richard, are you on still?
Yeah, Mark, I'm here.
Do you think your suggestion? Good, thanks. Do you think your suggestion is realistic?
Yeah, it is. Salita Morcelli is our new CEO for the Americas, and I know that her and I work together at JP Morgan. So, you know, I can pose 15 to 30 minutes of her time to discuss how we look at asset allocation globally, and where the trends are for international investors looking to optimize opportunities in the US coming out of COVID.
Good. Well, just it's an example where if it works September or October, or a separate event, we're going to definitely have a deeper dive on the asset allocation. So I see 20 out of, I'll show the results here. Anybody who has not voted? Then I will.
I haven't voted. Where do you vote?
My man. So you just, there's a poll. You just flashed on your screen. May not show for your iPad. But in the interest of time, we've got most people voted. I'm gonna end it. You can see it. So it looks like FinTech, yeah, the deal showcase, that's interesting. Because, you know, we don't really pitch unless we really tell you we're gonna pitch. So we can do that. Real estate, not as many as I thought. The asset allocation, and yet sports, Asia impact cannabis, not as much. 60 minutes seems to be the preferred time by far, and 30s. Okay, good. Anything else we want to talk about before we break? Sounds like the mood is a little, you know, as I think I heard someone in the other group breakout, you know, that like this intensity is going to be maintained. It's like this, and then someone in that same group, I think it was Torrin, was like, you know, the New York schools start date has been moved back, and that's not a good sign. It's not a good sign that you're talking about mental health of all the parents and how you're going to take care of the kids and the productivity levels. But anyone else?
Just letting you know, I sent you that data you asked for on gaming stuff in email yesterday.
Do you want to share that with anyone?
I mean, if people want to hear, sure. I don't want to take up everyone's time. I know around lunchtime everyone wants to eat.
Well, you know what I want you to do is post it on the app.
I can absolutely do that. It's not a problem. I just remember last week you guys wanted to have the debate as to the issues with gaming, whether there's gaming addiction versus gaming as a benefit to health. I'll just tell you the gist because I'm not going to read all the reports. I can send them and put them in the app. But the gist is, Yes, there's gaming addiction, like anything else. But what tends to be is the people who get addicted to gaming are the same people who have a gambling addiction. And so causation doesn't exactly mean correlation. So gaming may not be the cause, but it may be a deeper psychological issue with addiction, which is certainly a problem regardless.
Pause for a second because I'm looking at MJ. MJ's got an app that's really helping people with addictions of a sort. So you guys should maybe compare notes.
Yeah, well, gaming addiction is new, and I guess good for business, not very good for the person. And that tends to be the case in gambling as well. I'll tell you the benefits, which are actually very large. One of which I find very interesting, many ways patriotic, is they're finding that games can help veterans in several ways, people who come back from war. First, as a hobby, because they've done studies where they found veterans who come back and can afford and can play video games find that they're more relaxed because they're out of their out of body experience. But the more interesting note about veterans is that there are some scientists and programmers that are working on making games that work as actual medications for veterans. So in this way, they're using VR and gaming to relive the veteran's experience. So someone who has PTSD and can't, I don't have PTSD, so I can't speak to what the conditions are. But when you have PTSD, you have relived these sort of nightmares, these things that cause the PTSD, of course, from the awful issues of war. These games will allow these veterans to relive those experiences, those nightmares, with a therapist by their side to work through those issues. So they're actually using gaming as a therapy.
Jonah, just pause. Other thoughts? Because I know Joan or MJ does have some insight on this, maybe.
Yeah, hey, Mark, it's Rob. I got in a little later. Did you guys talk at all about the fact that they did play a college football game? I think that was very symbolic, and there seems to be camps of, hey, let's do things virtual, but there are camps of doing things live, which kind of affects what happened this past week with the professional sports boycott and then them coming back. I think that touches even some of the Hollywood stuff as well.
I didn't see that. Who played who?
It was like a Division II or Division III game last week, and I think a lot of the major conferences, some have said they've canceled college football, and some are still moving forward as is. I think the ACC and the SEC is still going forward, but it just seems to be kind of, you have some conflicting mandates, but it's interesting tension.
Yeah, no, it's a lot of counterbalancing. One thing I'd say, MJ, just to segue to you, is my daughter's involved with something that Kevin Love, I don't know if I told you about this. Kevin Love had a mental breakdown, and he was on a Zoom with her as they're creating a program for her to be an ambassador to basically help kids know, and particularly in this online time, that a lot of people are going through, tumultuous, internal issues that they're not expressing. So I think that there's that. But maybe MJ, segue to you.
Well, yeah, no, thank you. First of all, Jonah, thanks so much for hitting on that. Nir Eyal wrote a book called Hooked, which I'm sure you're familiar with. We can use gamification to either hurt us or help us. And I think what we need to do is we need to start learning, to your credit, what you were just speaking about with regard to PTSD. And we need to start looking into throwing everything we got into mental health. And, gamification is something that is so common, right? And if we can take that and turn it to good as opposed to destructive, I think we can do great things with it. Yes, the mental health challenges that we have within the addiction community, the one thing that we tell people not to do is self-isolate, and here we are. So we have to, in my opinion, throw everything we have into mental health right now, because we have a moving target. So I can come up with a business plan around anything that I see that's not going to move. But the
MJ,
goal keeps
you're not on our app. What's wrong here?
I am on the app. I am on the app.
I don't see you. I don't know.
I am. I'll go back in. No, I definitely am. But I'll start conversing more. But You know, but I think we have to throw everything we got into mental health, because what we have is a moving goalpost. And, you know, Mark, what you're talking about with regard to Kevin Love, you know, the same thing with Bruce Heron and all these, you know, ex-players that have run into challenges. Everybody's been affected in some way, shape, or form by alcoholism or addiction. And then the greater scope of mental health, I think we're going to need to throw everything we have into mental health right now.
Yeah. Well, I know there's a lot of things, even in esports, that we're doing for health.
Let's hit. I don't want to, just to keep it moving. MJ, you may want to put a link to your app so that people know about it. And same thing, Jonah. Throw it and make sure you're on the app and post it there too. Anyone else with perspectives from your geographies, industries? Torn, you're coming.
I just want to add something to the gamification question. I think the whole point of the gamification presence is it's supposed to short circuit the brain's concept of like a limiting factor. I mean, we can gamify everything and we can trick the brain into wanting to do things over and over and over again with gamification. I think we can become addicted to just about anything, it seems like these days. I mean, maybe the gamification trend is not a good one. We're wiring the brain.
I actually have a counterpoint to that, if you don't mind. That was one of the other studies that I found. The FDA has cleared, and this is a medical company who found a way to capitalize on it as a business, but it's altruistic, and it does help a lot of people. They're finding that if you make certain games that deal with certain rhythms and patterns in the brain, this game that they would actually give to kids as a form of medication can reverse some of the issues that a lot of these kids have with ADD. So the very thing that people claim that video games cause, which I would argue actually social media causes it more than video games, because video games actually take more attention to focus on than social media, can actually be used, as MJ said, to reverse this very same effects they're claiming is causing it. And this was approved by the FDA, so it's a very serious drug. And I'll put the link in the app, but they're really moving fast on it.
Interesting.
This is Yvonne Berry.
Yvonne.
I think we could jump around and make anything healthy. Alcohol is healthy. Marijuana is healthy. You know, if the way you position it, it could be healthy. I personally have seen very destructive behavior from video games. I think there's a lot of imprinting going on there. And maybe it's the same kind of imprinting that we have with cartoons years ago when they would have subliminal messages. Now, I think all I'm trying to say here is I think there is a lot of good things about gaming, but I think we need to have some kind of disclaimers in these games when they're using subliminal messaging, certain music, certain kind of hypnotic behaviors that are imprinting the children. And that will help define when the game is a healthy game and when it's not.
Well, in that case, you could argue all of Hollywood needs that then, because it exists in every media, from Cardi B's recent song, which I won't mention the name of that song, all the way to your favorite movie like Fast and Furious. Every single piece of media has done that since the very founding of media. So that would be a much larger discussion beyond just gaming.
Well, okay, and I'll not to over debate it, but the last thing I'll say, it's different when you watch a film, you see it once and then it's gone. And so whatever imprinting that's going on during that time is moved on, potentially, depending on how good that is.
Unless
but
you're
we're
binging.
What?
Unless you're binging.
They're binging, right? Exactly. Well, yeah, they could say that a lot about other things. And but the video games for children are just really serious, and the question is, how many of these kids that are coming in and shooting up schools, how does that interfere? And yes, of course, there's lots of learning. And
can I suggest this is okay? It sounds like this is a great topic to explore. We'll mobilize this into a 30-60 minute. You'll see how we're gonna do this. One thing, just real quick, what we did is we've created a playbook. Well, two things you can see: Monday, Tuesdays, the schedule of how we're doing this digest that I had shared earlier. But if you want to find who are in your groups, there are different things you can do. There's a Google Sheet. All these things have been the links of which, here they are, for example, all the alumni groups. But the other side of the coin is how do you execute? So, and how we can support you. So we're setting up a lot of mobilization calls so that those people, let's say it's e-gaming or it's gaming in general, and then we have a playbook of how we can help you. It's all in this, and we want to get these groups I want to have like 20 co-leaders for each group, because then dynamically they can, I think Jack Wyant mentioned something for wellness and how that was, a lot of ventures are taking off, and at the same time there's a huge need where we've got problems not only with addictions but obesity and all the rest. So there's other groups, there are other, let's say, events that the events might even beget clustered groups and of course then the whole asset allocation discussion is going to be really things we can do with that together. It'd be fascinating. Any last comments, words of wisdom?
Let it be.
Well, maybe just there's some new people too that have joined this one, like Warren Turner. You want to introduce yourself? You're on mute though.
Sure.
Hello, Anderson. Hold on.
Hello, everybody. Mark, I appreciate the invitation. I founded a group called Anderson Alumni about 20-something years ago. We've got about 20-something thousand members in our group. And Mark and I just connected on LinkedIn, and he was kind enough to extend an invitation to today's meeting. I found this very interesting. So trying to process what I've witnessed today, and just thanks for being here.
So you'll see on the September conference, we break out by alumni, and we have an Arthur Anderson breakout. And that's the one firm, and 361 firm is from Anderson, where I was a partner as well in Eastern Europe. Who else is new? Majd, have you introduced yourself to the group yet?
I have not. Thanks, Mark. Hi, guys. Majd Maqsad. I'm the co-founder and CEO of a consumer fintech called Status Money. We're effectively a social platform where people can crowdsource financial advice and kind of create financial wellness together. Pleasure to be here. This is a great conversation.
So you should be in that fintech breakout and the fintech deep dive we're going to do.
Yes, I would love that.
Who else is new? Darren Wallace.
Thanks, Mark. Hi, everyone. My name's Darren Wallace. I run an investment firm down in the suburbs of Philadelphia that focused on small and mid-cap public equities, looking to take a concentrated position in the public float and influence on a constructive basis with management teams and boards to bring price and value together. Thanks very much for including me, Mark.
And while we haven't diligenced it yet, it has a fairly compelling track record, but caveat aside.
Thank you.
And Zach Nasser, actually, you have a new initiative. Do you want to discuss it, or you want to do that next week?
We could do it next time because I have to jump to a meeting. But I'll just briefly say we have a bunch of stuff planned for impact and philanthropy groups, you could say, and they link up to everyone else because we'll hopefully be engaging the different foundations everyone's involved in, and it'll be gamified in a way like the gamifications mentioned earlier. So get excited.
Great. I met Zach in Dubai when he was with Emar doing corporate venture. Anyone else new that hasn't had a chance to introduce themselves? Oops. No? All right. Well, I thank everybody for your time. Richard, let's touch base. And my team, I'll touch base with you in about 15. Thank you, everybody.
Thank you, Mark.
Thanks, Mark.
Cheers.
Happy Labor Day.
Yeah.
Indeed.
Same to you.
Take care, Rob.